I got a question. Are we in a bull market or a bear market? So the short answer is that we don't know, right? Nobody really knows. Like if you look at Yahoo Finance, for example, right? If you scroll up and down, they're gonna, some will say, we gotta protect yourself, inflation coming, gotta do all this hedger stuff, get into cash, like, buy gold, blah, 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 blah. But then article right above it will say something like, hey, we're in the biggest bull run of the history, like, hey, buy this stock because, it's gonna go to like 1000x and some product is gonna revolutionize the world. And Elon Musk, he's pretty much every other article in Yahoo News these days is is gonna be killing it with Starlink and SpaceX and all that, his companies, right? New EV is taking over. Biden's infrastructure plan is gonna revolutionize the country and do all kinds of stuff for the infrastructure world. Or else something happens, right? And the reason why this happens is because, well, number one, nobody knows, right? Nobody knows the future. If these article writers, they knew the future, they're not gonna be writing articles, right? They're gonna be buying stocks, but nobody knows. But that's why, if you do sentiment analysis, if you're like a AI person, or if you do, text processing, natural language processing, and you just do a analysis, right, you'll find that most of the articles are 50-50, right? So, these guys, I mean, and you gotta understand, like, what are these people pushing, right? Like, for example, I don't know if it's showing up here, but there's a lot of guys selling gold, right? Selling gold ETFs and stuff. Like the Rich Dad guy, he has one of his advisors are like saying like you should buy gold or silver. It's probably here. They'll say like buy gold because it's a great hedging and all that stuff. But ultimately, they're selling you something, right? They have an agenda to push you, right? Of course, there's PR guys like Biden, right? He has a PR team probably trying to get you to like buy more government bonds so that they can print more money and do infrastructure stuff. So you have no idea like what the world thinks. So here's the thing: what are you supposed to do? Like, how are you supposed to know that we're in a bull market, bear market? Should you be buying protection? Like, should you like go into cash? Like, do you buy some bonds or something? Like, what do you do? Like, you buy more crypto or something? The answer is nobody really knows. But I'll tell you what you can do. So here are some things that you should definitely look at to see if we're in a bubble, okay? So the first thing that I would look at is this thing called, let me scroll up. It's called Shiller PE ratio, okay? So if you guys don't know what, let me move my head there a second. If you guys don't know what you guys know what PE ratio is, right? PE ratio is basically price to earnings. So if you pay for a stock and the stock has like PE of 10, that means you are paying $10 for $1 of their earning, right? So obviously you want to pay low PE. You don't want to pay high PE. High PE means like you're paying more, so right? So your yield is less. So here's what's happening, right? So Shiller PE ratio is inflation adjusted. Let me see the definition up here. So it's a inflation adjusted earnings from previous 10 years, right? So basically they're saying like whatever the earnings is, you gotta adjust for the inflation, right? And that is across the market. So if you notice, right? I don't know if you guys can see my mouse, but anyway, 1930. Look at 1930. All right, let me zoom in there. If you look at 1930, right, there was the Black Tuesday. That was the thing that caused Great Depression, right? That thing dropped like, I think this is the index, right? So the P ratio went from 30 to 5. So it dropped like, what is 25 divided by 30? Like 80%. It dropped 80%. That would have been a good time to pick up, except, a bunch of other crashes happened, right? And let me move my thing over. If you look at 1965-ish, there was another crash, right? And it kept crashing and crashing and crashing, and it sort of bottomed out in 1983-ish, right? And if you look at 2000, I'm sure most of you guys are like old enough to know what that is. That was the .com crash, like 2000. If you go 2000 was 45, and 2002-ish it dropped to 23, right? So it dropped like half. So Shiller K ratio, it basically takes PE across the board, right? And it tells you after you account for inflation, right? If the PE ratio goes sky high and then inflation is sky high too, the graph will adjust accordingly. So right now we're at 39.51. You see that red dot there? So that is super high. So you ask yourself, does that mean we're gonna be, this looks like 2000 levelish, right? Like if I Yeah, so if I just go 2000, yeah, so that looks like 2000 level. Does that mean we're due up for a crash? Well, maybe, maybe not. I mean, who knows? Maybe it could just go straight to the right. I mean, I don't know, right? But that is something that you need to be aware of, because this is, no organization collects it. I mean, no, like companies can't like really fudge this data, right? Governments can't either. This is across the board. It's just open source data. It's just on the web. So this is something that you need to be aware of. And the second one that you should be aware of is this thing called the Warren Buffett indicator. Basically, this tells you what percentage of the stock market value, like the aggregate, as a function or as a ratio of the total economy. So what this 216% is saying is that the stock market is about double the value of the U.S. economy. Okay. Now that, if you think about that for a second, the stock market should be the sum, right? Should relatively be the sum, right? Because not everything is publicly traded, for example, right? Not all companies are on the stock exchange. I mean, some of the world's biggest companies are not on stock exchange. But it should relatively be this. It shouldn't be like up and down, like, crazy percent, unless there's a bubble, right? So if you look down, yeah, here we go. There's a chart right here. So it should be, relatively the same, but you see it has this like wild swing, so it goes up and down, up and right. That's usually because there's a boom and bust. So it's saying that right now, let me move my head there for a second. Whoops, sorry about that. I meant to move my head. We should be relatively in the same range, right? But obviously this doesn't be the case because, well, we are in a bubble, Now, what does that mean? It's going to crash? Who knows? The third one is this thing called Greed and Fear Index. So Greed and Fear Index is, I don't know how CNN calculates this. Basically, it tells you, like, how do people feel, like, how good do they feel? Are they bullish or bearish? I mean, I don't know. I don't know how they sort of acquired this. I mean, how they get at this number. I don't know. I guess they have a formula or something. I didn't check it out, but I would say it's fairly okay. But here's a more quantitative thing that you can look at is SPX put call ratio. So if you guys know what let me move this a second. If you guys don't know what a option is, right? Option is basically a way to hedge. Hedging means like you want to reduce risk. So the way you can reduce risk is by buying a put. Okay, if you buy a put and the stock market goes down, that means you are protected. So it's like insurance, right? And call is the opposite. Like if you feel bearish, you buy a put. Okay, so put call ratio basically implies that put call basically is showing you fear divided, the fraction is fear divided by greed, right? So if you have a ratio of 1, that means as many people are afraid as they are greedy. So what that means is, it's 50-50, so the market's not going to do anything. If you have put call ratio of 2, that means twice as many people are scared as they are greedy, right? So that means there's people are panicking. Now, if you look at this chart, we're at 1.82. By the way, we're never at 1. It's if you look at the max, I'm gonna click on max. They make me pay. Okay, I think 10. No, they make me pay too, bastards. All right, so let's say 5 years, right? It's never at 1 because people are always afraid. People, like for example, pensions and like retirement funds and 401k managers. These guys are always afraid, right? Because they don't want to lose money. Because if they lose money, then they lose their job, right? They're multi-million-dollar paying jobs, so they're always gonna be hedging. So that's never gonna be 1. Just letting you guys know. Anybody who says we live in an efficient market, the efficient market hypothesis, we're never efficient. Okay, it's never. That makes no sense. I mean, I can tell you. Look at this chart, right? If it was efficient, right, there would always be as many greedy people as there are afraid people. But that's never the case. People are always afraid. That's why if you are an option seller, like if you sell option puts, you do okay because people are always afraid, right? People never want to lose money. I don't care if it's like the worst market, the best market. People always want to hedge. So right now we're at 1.82. So I don't know. Do they have like a median? No, okay, they don't have it. 1.82 is relatively high, meaning that it's above the normal level. So people tend to be on the afraid side. Well, partially that being the Feds have been printing money, right? I'm sure you guys have seen this Fed money meme, right? Yeah, there we go. This guy. I don't know if you guys. I'm sure you guys have seen this meme where this guy is like printing money, right? So just letting you guys know that. Let me close this one. So letting you guys know that the coronavirus and the lockdown and all that money that's being printed, that's going somewhere. And obviously it's going to the stock market, right? So the last 18 months have been like crazy. Like Tesla went up like 10x. Bitcoin went up. Like when I was looking at Bitcoin, I was kind of interested. It was at 12,000, and then I wake up a day later, it's like 40,000. It was crazy, right? So all that money went somewhere, right? It didn't go just nowhere. It didn't just go to like Amazon, people buying food and stuff. It went somewhere. So people want to lock in their profits. So the way they do that is by putting options, right? Or they'll hedge by like doing something like they'll short something, right? So that's another thing. And here's another one. Here's a major one that you guys definitely need to look at if you were to decide whether or not we're in a bull market or a bear market, is Reddit. Reddit, social media in general, but Reddit is easier to analyze. So if you guys don't know Wall Street Bets is if you don't know Reddit is basically like a forum. Okay, Reddit is a forum. It's anonymous, and you can post whatever you want. People put tons of like memes and stuff. Like I don't know if you guys know GameStop. Basically it's like this old retail company that's basically dying, and these guys bought tons of call options, and so the hedge fund guys bought like shorts, and then basically the little guys were trying to screw the rich guys who are trying to basically short this company to death, right? So these guys kind of saved GameStop, but there's a lot of drama based around that and stuff. Anyway, so that's what Reddit is. Reddit is basically a forum. Now, problem with Reddit is that there's people often just like pumping stocks for sake of pumping stocks, and just to get out of their position, or whatever the case might be. But that's not what you should be looking at. You should be looking at the aggregate data, which is like who is in it, how big is it getting, and how many people are in it, and you got to look at it over time. So let me tell you why I think it's better to be on the more cautious side than bullish side. With caveat, but that's you have your own opinion. This is not financial advice, obviously. So if you scroll down here, take a look at the subscriber count. So it's basically flat from 2013 to 2018, and then notice that from 2018 to 19 to 20, and boom, 21, this thing happened. Like this, it went from 1.8 million to 10 million, right? That's crazy. You tell me, 8 million people all of a sudden just wake up and decide to become interested in stock? That doesn't. For me, I looked at stock first time in my life. I was like maybe 12, but then for the next 18 years, I didn't. I read like one here, one there, and then I kind of got interested. But still, even after that, it took me like a long time to get interested. Not like overnight, I'm like, hey, I'm going to just all of a sudden open a brokerage account and just start trading stock. No, that's because the media has pumped up all the stock stuff, right? And a whole bunch of people got involved, and GameStop's in the news, and the politicians were talking about GameStop, and crypto, like people are talking about crypto. If your cab driver is giving you stock advice, if your friend, we all have kind of a dumb friend, right? If a dumb friend is telling you to buy crypto, the chances are there's probably greed in the market, okay? Is that always the case? No, but in general, right? That's in generality, because finance is boring. Let's face the reality. Even when I watch YouTube, I do watch a lot of finance stuff, but when I'm bored, and I have time, like waiting for a flight before it takes off. I'm watching stupid stuff like pet stuff, cooking shows and comedy stuff. I want to be entertained. But most people, but things have changed. Why? Because people keep seeing these posts on Reddit about like how this guy put in $3,000 and then now he's retired with $1 million in the bank account. So yeah, I definitely think there's a bubble. In the cryptocurrency world, yes, but with a caveat, because cryptocurrencies, DeFi, decentralized finance, is definitely different. I'll talk more about it in the future episodes. It's definitely different. So those are the things that you definitely need to look at. So the first thing I always look at is the Shiller Cape ratio. I always look at this. So does it mean we're gonna head for a crash? I don't know. You judge for yourself. But I am hedging, so it's up to you. Now, if you are interested in hedging, like how to protect your stuff, right? Protect your money without doing all crazy strategies. I'm not sure if you guys want to see it. You put in the comments if you want me to talk about it. Another one is the Warren Buffett indicator. This is more subjective than objective, because, like I mentioned before, not everything is stock market, right? Like, I don't know, it's good thumb, but not like set in stone. Fear and greed index is pretty decent. I look at this a lot, SPX, put call ratio. So SPX, SPY, it's pretty much the same thing. And another one is Reddit. So yeah, those are the tools that I would definitely look at for you to judge whether or not what kind of market we're in. So anyway, if you found this value, comment, like, share, right? Thumb up. Because I have no idea what you guys want to see unless you react. Okay? I'm on the other side of the screen, so I can't tell who you are, what you do, what you like. Anyway, I'll see you in the next video.